All right, good morning, everybody. Today is Thursday, the 23rd, and we're gonna sort of move over to chapter 8 here. And I know that as I've said before, a lot of these chapters are very dense in terms of content and whatnot. And I didn't quite get all the way through what I needed to do in chapter 7, dealing with cash and receivables. I'm going to post a supplementary video in order to sort of bridge that gap a little bit. We just don't really have time, and frankly, a lot of the onus is on students to sort of do the reading and do the homework and the practice questions and whatnot. This is what makes intermediate accounting a little bit different than other courses, and it's somewhat challenging. But I will do my best to try to get you back up to speed here with regard to this. Just we have limited amounts of time. A couple things regarding the schedule before we get started here is the idea that the Smart Book quiz being due on the 24th, which is tomorrow. And that deals with cash and receivables. This is both accounts receivable as well as notes receivable. We just started in my video lectures, which they seem to all be video lectures because most students would rather view the videos as opposed to come to class, which is fine. I think we really are only getting into the notes part of this, but we will, and we'll talk more about it. And by the way, a lot of this information is going to be helpful as well on the next exam as it comes up, which is going to end after this next particular chapter that we're going to start today, which is chapter 8. And I'll talk about why I'm sort of jumping ahead here. Not really jumping ahead, actually, we're sort of on track, but I want to make sure that we have enough time to talk about some of the intricacies dealing with chapter 8. So before I get to chapter 8, one final thing is homework and bonus. This Sunday, the 10/26, both of those dates have been changed and adjusted in both Brightspace and Connect. And I know that the syllabus itself, I didn't write the syllabus, and so sometimes the due dates really don't align very well with what I think is best overall. And as I've said a number of times before, I'd rather give you more time to do something as opposed to less. I think it's better for you, and if you want to sort of budget your time, you can work ahead if you like. But I'd rather push due dates back, and I can't imagine a situation in which I'd ever move them up. So that's chapter 7 that you want to deal with this week and get that knocked out. And then for next week, then we got a couple things going on. We're going to the chapter 8 inventories, which we're going to start today. The quiz is going to be due Friday, the 31st, and then the homework and bonus on that Sunday. But also we have the second exam, and hopefully by next Thursday I'll have a little bit of time to talk about the exam, give a little bit of overview as to what to expect on that exam, and that way you're more prepared to what to expect. Okay, so we're kind of at the midway point of the course, and we're pretty much on track. Despite some of the weird issues we've been having, which I think are behind us. I think a change of room was all we really needed there. So it's amazing what that can do. But nonetheless, that's where we are. And so I want to sort of begin chapter 8 and talking about what's going on here. And so. And again, I will post a supplementary video in the week 7, or I'm sorry, in the chapter 7 module. So look for that. It's going to be on a class of lectures, that class of lectures tab. It shouldn't be difficult to find and scroll down. If it's not today, and I don't really have access to all the rooms that have the equipment every day. If it's not today, it'll be tomorrow for sure. Hopefully earlier rather than later, but look for that. But why I want to get into inventories is because it's, in my experience, inventories are one of the trickier aspects of financial accounting. We've got a number of different inventory measurement systems and some assumptions that back up those systems. And sometimes people struggle with them. And I'll admit that as an undergraduate a long time ago, inventory was probably the trickiest area for me, frankly. And so if it's tricky for me, maybe your experience will be better. But I do know that it's something you got to really kind of look at, kind of study, and we're going to get to it. But today, I think we're going to talk mostly about what some of the basics of inventory measurement are. Some of this is review. Some of it should be review from Accounting Principles 2, where we talked about the idea of how we absorb the cost into the good itself, what things we're absorbing as that good moves along the production process, if it's a manufacturing operation. If it's a merchandising operation, obviously we're talking about finished goods already coming in, but still, nonetheless, there are additional costs that are sometimes part of the inventory cost itself. So we call those product costs, and they differ from all other costs which we simply call period costs, which are things like interest and things like rental expense on the headquarters building, and of course textbooks love to talk about the CEO's salary and whatnot. Those are clearly not dumped into the product cost itself, typically. So when we talk about inventory, real quick definition here: inventory refers to those goods which are being held for sale. Okay, and I think if you took 2120, which is principles 2 here, we had a discussion activity that actually sort of highlighted the difference and focused on the difference between goods held for sale and goods held for use. And I think it was Hewlett Packard and HP has inventory that's for sale. It's a current asset because these are goods for sale, but they also have their own computers that they use as a long-term asset. So it really is, the designation is it intended for sale? Is it stock in trade, in other words? And that's really what inventory is. And so if it's intended for sale, it's definitely inventory, okay? And it's held as a current asset. And then the value of that is released to cost of goods sold. So one of the things about cost of goods sold that's interesting is, and particularly in a manufacturing operation, is that sometimes the release of expense through cost of goods sold is a long time down the road. Excuse me, it can cross accounting periods. So the cost of goods sold really relates to the idea of how do we recognize the cost of that inventory itself. And because remember, in the income statement, that really the two top lines are net sales minus cost of goods sold equals gross profit. And that's a reality that you'll see again and again on pretty much all income statements. And so cost of goods sold is really the major expense, but it's deceiving in some ways because there's a time lag, particularly in a manufacturing context. But we'll talk about different types of business environments, and we'll go from there. So again, some of this hopefully is a bit of a review for a lot of you. So we talk about merchandising inventory. We talk about merchandising operations, and it's usually the first kind of business we study in the introductory courses. Where you've got a business that buys finished goods, they're not making anything, there's no production operation going on, there are no workers building things. Walgreens, Walmart, Target, they buy finished goods, and as a result, they purchase those goods that are already done. And so the cost of the inventory includes the purchase price plus any other costs necessary to get goods in condition and location for sale. Now, there are a lot of elements that may play in here, and without wasting a lot of, or spending a lot of time talking about that, there are things like, do we have to clean the goods up? Sometimes they come in pretty rough shape. Do we have to build display cases? Do we have to do whatever? All these are costs that are inventoriable, and we dump those into product costs themselves. In other words, the inventory cost. So when those goods are sold, it becomes part of cost of goods sold. Manufacturing definitely is more complicated in the sense that we are producing goods, usually beginning with something like raw materials. And when we talk about raw materials, I think sometimes there's a misunderstanding of what we're talking about here. I think sometimes people feel these are goods that just got dug out of the ground or extremely raw, like crude oil, which is definitely raw material, but it's not the only raw material. Sometimes these are finished goods of some other manufacturer, things like screws and bolts and paint and varnish and adhesives and all that. But to the manufacturer in question here, it would be considered a raw material. And so because it does not resemble the good that will be the final good produced. And so raw materials is one category. It's an inventory account. Okay, and then work in process, the WIP account is simply a collection of all the goods that are in process. It too is an inventory account. Remember, cost of goods sold, which is an expense item, really the major expense item typically on an income statement, isn't actually recorded until the good is sold, hence the term cost of goods sold. Otherwise, all these costs are what we call capitalized. That is, they're put on the asset side of the balance sheet because they're part of the product cost itself, okay? And then finished goods is pretty obvious as to what that is, okay? So there are some differences here, and we'll talk a bit about what those differences are and how we recognize the value of inventory. And as we go into next week, we'll talk much more about it. I do want to give a good 3 class sessions to talk about inventory because I really do think it's an important piece of the puzzle, along with revenue recognition, certainly, but it's kind of what I think is kind of the heart of the class, frankly. So, all right, so for a manufacturer, then we're talking about raw materials, these component costs, whether they're screws or whatever, right? They're not exactly, something that is just fished out of the sea or whatever, but they're component parts that would not be in and of themselves final goods necessarily, right? And companies buy these in bulk in order to make the goods they're making. The example, we're back to HP again, right? Computer chips, memory modules, they buy chips from whomever, Intel, NVIDIA, whomever. And so as a result, those become part of the good itself. Work in process is this intermediate stage that is capturing goods that are in the process of being completed. And where we see the WIP account being reported to external users, which again is what financial accounting is focused on, we're usually talking about goods that are in process as we cross an accounting period and we're bringing things current. These are goods that are not yet done, but they're in the process of being done. And so when we talk about WIP, what are we really talking about? The cost of raw materials, the cost of labor that can be directly traced to it. In other words, we're talking about direct materials, whether the raw materials or however you want to define it, direct materials, direct labor, and then manufacturing overhead. So remember, those are the three categories, and they're sort of big categories of product cost that we talked a bit about in 2120, or wherever you might have taken that particular course. And so so we're talking about goods which are not yet done. And so as a result, but they're still inventory items. There's no question that we would still view these as inventory items. And so we need to be sort of clear about that. Okay. So it's an intermediate. So WIP is an intermediate inventory figure, and it represents all these three categories on these uncompleted products. And as the goods are completed, they move from WIP to finished goods. And when they are sold, if they are sold, the value of that becomes a part of the income statement through cost of goods sold. That's sort of the natural progression. So when we talk about a manufacturer, we talk about finished goods. The cost of goods that have been completed but have not been sold are what we call finished goods. Still inventory, there's still asset accounts, right? They haven't been sold yet. And remember, it meets every definition of an asset. That is, it's the value of something that's been incurred as a result of past transactions, and which has future service value. And so as a result, finished goods are assets in this particular case. And so these are goods available for sale. Hopefully they sell faster as opposed to slower, but you never know what may happen. So as a result, that's what's going on. So Intel, which I just kind of mentioned a second ago, was potentially a supplier to HP in this case, which I think they are. So manufacturers disclose either in a note or directly on the balance sheet the dollar amount of each inventory category. And again, the presentation here, some of the vertical presentation is 1 year to the next, 2016 to 2017, where the inventory values are broken out in terms of these three particular categories. Obviously, Intel is a manufacturer, and so they're going to break these things out. Or they'll have notes to the financial statements that will break those out. So as long as the dollar figures are described in detail for users so they can find them. And very often, I think it's interesting that the way they talk about the notes. The notes are really important because they sort of give users a bit of a background into what's going on. Usually they can drill down a little bit deeper into where the numbers came from and why they're being reported as such and all that. And the management discussion and analysis piece of the reporting tells if there are significant changes and what those are due to, et cetera, et cetera. Okay. All right. So let's move on to inventory and the cost flow for a manufacturing company. Basically, we're talking about the debit credit progression. That's really all that we're really getting into here, right? So we have raw material. Where's my mouse here? So we have raw materials coming in. Raw materials are used. So raw materials being purchased is a debit because it's an asset account. Used, it's credited out, goes into work in process. Direct labor incurred, right? Direct labor is applied. And by the way, these are not expense items. These are put into product costs themselves. This is something that I think is surprising to people, is the idea that sometimes direct labor, well, not sometimes, in a manufacturing capacity, direct labor becomes part of product cost, not as just an expense or cost of doing business. And this is why when companies are producing and selling less inventory, they need less direct labor. And so as a result, they lay people off, and workers who are involved in production typically are laid off first before workers whose other jobs are sort of independent of the particular production and sales function. But And that's just kind of the way it is. But anyway, the debit credit progression, and we're sort of putting these into the debit account of work in process. And manufacturing overhead is kind of an interesting one here because there are a number of different methods by which we estimate and record manufacturing overhead, and we could do an entire semester, and I'm sure there are entire semesters in graduate courses about how to handle overhead. But whatever the case might be, as we are recording overhead, as we're estimating it, and remember, manufacturing overhead are indirect costs, and this differs from raw materials or direct materials, direct labor, which we call direct costs. And those are costs which can be pretty easily observed, pretty easily measured, especially direct labor. I mean, I think that's extremely easy because businesses have done a very good job over a long time period of capturing wages that are involved in the production process. Sometimes it may be challenging to put it onto a specific product when people may be moving around from job to job, but nonetheless, it's relatively simple. Raw materials may be a little bit more complicated, but even there, like the use of QR codes and whatnot, which was designed as an inventory measure to begin with, makes that job a little bit easier. Manufacturing overhead, though, unlike these other two categories, are indirect costs. And they're, once again, as a review, what are they? They're things like rent expense on production facilities, insurance on production facilities, production supervisors' salaries, quality control inspectors' salaries, all these kind of things, which is difficult because they sort of move around. And I know that we have to sort of have this view that companies don't just make one good. Usually they may make several goods. And so as a result, people are moving around and whatnot. So you have to do the best you can. And there are a number of different methods. Activity-based costing is one method. But for our purposes here, what we're really interested in is this idea of the debit credit progression, where we're incurring overhead, we're crediting out, and we're dumping it into work in process, which again is a debit balance because it's an inventory account. And then once those goods are done, all that boom goes over here to finished goods, which is a debit. And once those goods are sold, we credit that inventory account. The inventory account is finished goods, and we release it through cost of goods sold. And cost of goods sold, from an accounting standpoint, is the end of the line. Those goods are gone, they're done, they're out of here. Yes, I know goods can come back as returns. We talked a bit about that before. But in terms of costing these goods, that process is done with cost of goods sold. And so, again, as I mentioned, I think last time and the time before, that a lot of what we're doing here in the remainder of this particular course is talking about balance sheet construction and reporting and all that. But there's no way you can divorce the balance sheet from the income statement. They just sort of fit together. And so cost of goods sold obviously is an income statement item. But that's something we have to recognize as being a sort of reality. Okay. All right. So I don't think we have anybody on the Zoom call at this time. So that sort of makes a lot of sense. Oh, by the way, here, one of the things I should mention is what are we doing here from an accounting standpoint is we're debiting cost of goods sold and we're crediting finished goods, right? Remember, cost of goods sold, which is an expense item, is a debit balance account. And finished goods is credit balance. So debit cost of goods sold, credit finished goods, and for whatever dollar figure there are, we don't have, this is a generic model here, but that's the way that we handle that particular movement as goods are sold. Now, this leads us then sort of not coincidentally to the next subject, that is the perpetual inventory system. And let's talk a bit about that because this is really important in terms of how we recognize both the cost of goods sold and the reduction in finished goods. Which finished goods? Which exactly are we talking about? You're talking about companies that have maybe thousands of goods and individual unit numbers and whatnot. So this is where a perpetual inventory system really is superior to its alternative, which is much more old school, and that's the periodic system. But we'll talk about both here. And I don't mean to demean the use of the periodic system, because sometimes it has its uses, particularly due to its simplicity, and if it works, it works. But when we talk about bigger companies, wholesalers and retailers, I think perpetual inventory systems are far superior. And what they do is, as goods are coming in, ordered from suppliers, they get booked directly in inventory right away. And as they're sold, they're taken out of inventory right away, and the cost of goods sold is recognized immediately, and I mean right away. And this is not new. The technology is not new. I think I've told students before that when I was in college back in the mid to 80s, right? We had a perpetual system at Target where if you sold a box of diapers or whatever, they would come out of the inventory right away and it would go over the phone lines. This is all before the internet or anything like that, and it was simply the way that sellers could connect to some system by which we adjusted inventory. So purchasing managers then would be able to use that and say, hey, we need to order more of this particular good for this location or less or whatever. And this idea of giving more or less real-time information is important. So it's a continual basis, hence the term perpetual. Everything's updated. Both purchases of inventory go into inventory, reductions in inventory through sales happen right away. And so everything is adjusted. And so that in real time, or more or less real time, managers can see what's going on. And they can see it by location, by region, however they want to slice and dice the information itself. Okay. Also things like returns and all that, and also inventory levels. Now, this doesn't mean that the physical count of inventory is negated, because one of the things that we talk quite a lot about, particularly nowadays, because a lot of companies are talking about the idea of shrinkage, and we're seeing sort of an uptick. At least it's being reported, an uptick by retailers of retail theft and whatnot, and so that's what we call shrinkage. The shrinkage of what? Shrinkage of inventory, and also the shrinkage of the opportunity to make gross profit on those goods. And so so there still is a need for that. And we'll get to that particular discussion a bit later. But that's what a perpetual system does. So in this case, we have an example. This is an example we're going to kind of carry through here for a bit. The Lothridge Wholesale Beverage Company purchases soft drinks from producers. So these are finished goods, right? And they sell them to retailers. So, and the name itself, it implies it's a wholesaler, right? So, there's no ambiguity about what this company does. They buy from producers, manufacturers, sell to retailers. They are a middleman in this particular transaction. So the company begins 2021 with inventory of $120,000 on hand. The following information relates to inventory transactions. So they've got additional inventories purchased at a cost of $600,000, which goes in inventory, right, in a perpetual system. Sales on account, and they're all on account, which is not unusual in a business-to-business relationship. Business to consumer, a little bit less frequent in terms of creating a receivable for the seller, but we're going to create receivables for all these sales, and we'll have aggregate journal entries here in a second. And then the cost of the soft drink inventory sold is $540. So using the perpetual inventory system, the inventory on hand at the end of the year is $180,000. And so we're going to sort of look at this particular scenario, this example here, and talk about what's going on. So here are the journal entries that are affected as a result. And again, these are once again aggregate journal entries. These are not one journal entry that's done at some end of whatever. They're done as time goes on. Every time goods are received in the receiving department, inventory is increased. And because of the fact that they're bought on credit, there's an account payable also increased. So we have the debit credit matching. And over time, that's essentially what's happening. But also the sales, same way as goods are selling, the revenue, which is price times quantity, is going to be debited out. Is going to be credited, and we're going to have a debit on the other hand to recognize accounts receivable. And because the fact it's a perpetual system, as we sell these goods, we're also recognizing cost of goods sold as they're happening. So, and you could talk about the margin, $540,000 against $820,000 in sales. Is that a good, healthy margin? Probably. But the key thing is, in a perpetual basis, we're updating this constantly. So as a result, we book revenue at the same time. We also book cost of goods sold. Okay. And so we have debit, credit, and the credit here is to inventory, which is now gone. Okay. And this differs from a periodic system in the sense that we've got a much more real-time analysis of what's going on. And increasingly, management wants to know what's going on in real time, or what we call more or less real time. This is something that we see happening a lot in the business world, where CEOs want to come in the morning and see what exactly happened everywhere in the company yesterday. And they get, for that one day, just a sort of a limited slice of time as to what's happening. And they can slice and dice by region or by product or whatever they want to do. And it's possible with a perpetual system. It's not really possible with a periodic system. But this idea of what we call dashboard reporting is pretty important. The example that I think is interesting is Warren Buffett, the great investor who's been obsessed with the insurance business for a long time. Apparently, he leaves work, goes home, has dinner, plays some video bridge, and then wants to know how much in dollar premiums his insurance company sold that day. He wants that report that night before he goes to bed. That's just kind of his thing, and he's the boss, and so this is what's delivered to him. So you get the idea that the perpetual systems can deliver up this information very quickly so that decision makers can know what's going on. And more information is usually better than less, particularly that which is on a timely basis. And again, and I sort of alluded to this a second ago, this is really dependent upon technology. And so you really can't do this any other way without using technology that sort of is keeping track of individual goods themselves. If you're a wholesaler or a retailer, a lot of products, you've all seen these barcodes, these lines on a good itself, and they all represent individual product codes, called UPC codes, Universal Product Codes, and they've been around for a very long time. Barcode scanning, which allows sellers to know exactly what's happening. So, and we've all known this as buyers. We scan if we're buying, a box of cereal. We at Smith's, we try to figure out where the barcodes are so we can scan it on the self checkout. So we're all familiar with that. But what's going on in the background is the fact that it's adjusting inventory as a result of that particular sale. And also, and RFID tags are maybe a little higher end items, maybe like jewelry and I don't know, maybe vehicles. I'm not quite sure, but RFID tags are simply radio tags that sort of track some of these things. I know that casinos in Las Vegas are starting to use these because people were forging poker chips, which I guess if I had a criminal mind, I would have thought of that before they did. But it's pretty smart. But then now they're sort of foiling it with RFID tags. All they are simply send a signal and whatnot, and they can be tracked. Also, the QR tags, I mentioned a minute ago that it actually began as an inventory control measure, and we're seeing this being used more and more, this idea. In fact, all of us as consumers are used to scanning things with our phone and uploading it and whatnot. So we're all familiar with these. And all these are simply means of communicating with some host server somewhere in order to convey information so that users can understand what's going on. We can update things in more or less real time. So technology is absolutely essential to this. Cannot work without technology. Okay. All right. The alternative to this, and sort of the original method, which predates the use of technology, is the periodic system. And the periodic system basically is much slower. It's very bookkeeping dependent, and what happens is, as goods come in, they don't go into inventory directly. They go into what's called a purchases account, and the purchases account itself is adjusted for things like returns and allowances and whatnot. But net purchases is simply the idea of new goods coming in. So this formula is very important from a periodic inventory system. That is, the cost of goods sold is the beginning inventory plus purchases on a net basis minus ending inventory equals cost of goods sold. And by the way, you can rearrange the terms here. And we do this a lot in introductory accounting. If you want to solve for in the inventory, you just make this the variable that you're trying to solve for. And if you know what cost of goods sold is, for instance, then you can solve for that. So this is simply an algebraic equation, very simple, that talks about how we, at the end, usually at the end of some accounting period, determine what cost of goods sold and ending inventory were. Those are the two main issues the two main variables that allow us to do an income statement. Because remember, the income statement is done first after we do adjusting entries, closing entries, and whatnot. And we're going to do the income statement first. And we're going to need these figures because we can't get an income statement without cost of goods sold and ending inventory. And the two go together because they're really sort of linked together in part of the same transaction. And the thing about the purchases account is, as your slide package shows, it's a temporary account. And we talk a fair amount about temporary accounts as being those accounts which exist for a period of time and then are closed and then reopens, like closed at 11:59 p.m. on New Year's Eve and reopened at 12:01 or whatever on New Year's Day. And that's obviously, I'm exaggerating a lot, but but they only exist for a short period of time because they're not permanent accounts. And we tend to think of permanent accounts as being more balance sheet accounts and whatnot, and everything else on the income statement being a sort of a temporary account as we start the new game over as the new reporting period begins. And again, in public company reporting, the quarter is a big deal, and companies report on a quarterly basis, and they want to report these figures, and they really are expected to report in a GAAP basis that is taking into account all the accrual rules that we use, and quarterly reporting is a big issue. I know that I've mentioned before that there's some discussion about maybe making that reporting period a little bit less frequent, semi-annually, but we'll see what happens. I don't know. I have no idea, no prediction. Don't even want to predict what will happen. But you get the idea that the periodic inventory system, if it's used, which is not terribly in use in public companies, nonetheless, will report earnings after the fact. Okay. Now, and I know I sort of talked a good game about perpetual systems, but periodic systems may have a particular use. Okay, and particularly if you've got a company that maybe is primarily a service organization and that has inventory as sort of a sideline. And just as a personal example, I had a client once who owned a bunch of salons, hairdressing salons, and most of the revenue, the overwhelming, probably 85% of revenue, was service revenue for doing hair and nails and whatever it was, right? But they also sold some inventory. If you've ever been to a salon, they want to sell you, shampoo and fancy conditioner, all that. And as a result, because it was a small portion of the revenue base, they decided to use a periodic inventory system, which I think was probably fine. It's much simpler to use. We simply, as goods came in, we just simply debited a purchases account. We had, I think, very few returns, if any, in my recollection. And as a result, you simply had this particular, and at the end of the accounting period, you simply said, okay, all right, what do we have here? We have this particular formula. We have beginning inventory plus purchases minus the ending inventory equals cost of goods sold. And so as a result, cost of goods sold is still an element of the income statement, even though it may not be the most important element. And in this case, if you have a service business, cost of goods sold, the analog cost of goods sold is cost of sales. And we see that happening all the time, all over the place. All right. So let's talk a bit more about the periodic system, and and indicate that maybe for smaller businesses it may work. It's certainly those that are having some difficulty with technology or unwillingness to deal with technology, they may do it. And by the way, there are some companies that are so confident in their margins that maybe they don't really. Accounting's not their thing so much. I mean, I know this sounds completely crazy for an accountant to say, but there are clients of mine, particularly those companies that are involved in selling really high margin products, where they were pretty darn confident what their margins were, and accounting was sort of an afterthought. They were more their focus was more marketing all the way to the top management level, and let the accountants figure all this stuff out. We don't really want to deal with it. Just make sure that we're making money, that sort of thing. So, whatever works is what works. And so, all right, so back to our example of the Lothridge wholesale company. They buy soft drinks and then resell them. The same facts as before. Additional soft drink inventory is purchased at $600,000, and for this on the account total $800,000, or what? So, I'm sorry, $820,000, and they use the periodic inventory system. After a physical count of inventory at the end of the year, the cost of inventory is determined to be $180,000. So what do we have here? Let's talk about what's going on. So we have a purchases count of the $600,000, and we assume it's accounts payable because these are probably purchased on credit. And once again, these are aggregate journal entries, not individual. There's not one single journal entry. These are an accumulation over time. And also on the sales side, we have accounts receivable. We're selling on credit to customers, and we create a sales revenue account. But there's no entry here for the cost of inventory sold. And there's nothing, there's no credit to inventory, and there's no debit to cost of goods sold. Why? Because the fact that we are only going to do that at the end of the accounting period. And that's one of the issues that's involved with the periodic system, is the idea, and it's called periodic because we only update these as we usually are closing out an accounting period in order to move forward. So in this case, here's sort of the flow of transactions. Beginning inventory was 120,000. We purchased 600,000. We had ending inventory of 180. So what our cost of goods sold? The cost of goods sold are 540,000. This is essentially the formula we've been seeing before. And this formula is used in a lot of different places. Now, by the way, one of the things about the periodic inventory system is we use this a fair amount in cost accounting as well, particularly when we're talking about this category that sort of fits into cost of goods sold in a manufacturing context. We call it cost of goods manufacturing, where we use this particular methodology if we need to, just in order to arrive at cost of goods manufacturing, which is a part of product cost that moves its way down the line. So this is not without its uses. Okay, so again, the formula is beginning inventory plus purchases equals COGS, or sometimes called COGAS, or goods available for sale, and however you want to see it. A lot of accountants have, particularly academic accountants, have all kinds of different acronyms for this. I usually use GAFS, goods available for sale. It is the cost of the goods because we report assets at cost, right? Minus ending inventory. In this case, there's an emphasis here on per the physical count, and as a result, 720 minus 180 is 540, and that would be the cost of goods sold for that particular accounting period as we close that out, right? So goods available for sale are simply the beginning goods plus any kind of purchases, and that gives us throughout the accounting period all the goods are available for sale. And presumably, we're not going to sell all of them, but we do. But it's unlikely. You're probably going to have some of the ending inventory. So as a result, there's going to be a difference here. And the ending inventory then becomes the beginning inventory for the next accounting period as we go from there. And again, this is something we emphasize a lot: is ending values as of an accounting year end become the beginning values, whatever they are. For the next accounting period, whether it's assets or whatever, especially asset valuation. Okay, and again, the focus here is mostly on the balance sheet. So, all right. So in this case, what do we have? Well, let's take a look at this particular thing here. The bottom half of these aren't, and by the way, these aren't journal entries, but these are ending balances, and so all they are, look at them as like T account balances here. As to what's going on. So what's happening here in the bottom half? We have cost of goods sold of 540, and now we have ending inventory of 180. So that's the debit side of this event here, and the ending inventory, beginning inventory plus purchases, and so that together $720,000. And so as a result, this is how we balance, and this is how we get to ending inventory, to cost of goods sold of 540, and then from there we can close these accounts out. If this is year end, I presume it is. We're just going to assume December 31st is year end. We would then start with sales, top line, right? And then take out cost of goods sold and go from there. And that's how we create the income statement. But that's what's essentially going on with how we account for inventory and ending inventory and cost of goods sold, which are really the key elements here of what we're trying to do in this particular system. So side by side here, I don't want to go line by line through this because it's sort of laid out for you. But what are some of the differences between the perpetual and periodic systems? In the perpetual system, everything is decreasing inventory at the time of sale, increasing cost of goods sold at the time of sale. This makes it much more of a real-time sort of presentation. On the periodic scale, goods available for sale are sort of allocated among ending inventory and cost of goods sold at the end of the period. It's probably a little less accurate, to be quite honest with you. And we're going to talk much more about inventory and how we know when the good that we just sold, the bottle of shampoo we sold, when that was bought. And we don't know, really. I mean, the good that we sold on May 31st, did we purchase that on May 1st? Did we purchase it on April 15th? We really don't know. And we have to make some what we call cost flow assumptions, and we're going to get to that. So what are some of the other differences here? The interim financial statements are much more easily provided, simply because of the fact that we can use this sales data and inventory data on a real-time basis in order to do it. In a periodic system, it requires some physical count to make sure that we've got something resembling accuracy in terms of recognizing ending inventory and cost of goods sold. There's a caveat here that we should mention. That is, even companies, whether it's manufacturers, wholesalers, retailers, whatever, that use a perpetual system, will nonetheless do a physical inventory. And if you've ever worked at an organization that's done that, oftentimes there are companies that specialize in this, and they travel around. That's what they do, is they count inventory. They usually scan things based upon, if it's particularly if it's retail and the goods have a UPC code, scan, and they make sort of adjustments to that. We know that inventory goes missing, it gets stolen, lost, damaged, whatever. And this idea of shrinkage is important. So the idea of doing a physical count is necessary, not just in a periodic context, but also in perpetual context. But it's critical here in a periodic system because it's sort of the way you make that whole system work. On the perpetual side, it's more expensive, obviously, because of technology. It's less costly to implement on the periodic system. But again, there are cases in which a periodic system may make sense, and you may want to do that. And it's not, in particular, a small business or when inventory itself is not a particularly large portion of the revenue stream, it might make sense. It also involves the tracking of both inventory quantities and cost, which is what the technology does. And here you can only monitor the inventory quantities as you're going. So there are some definite drawbacks, but also some advantages to the periodic system. I think if we're talking about publicly traded companies, for the most part, a perpetual system is really what's being used. And, particularly in the manufacturing context, but also certainly in wholesale and retail both. When we talk about service businesses, we're not really talking about inventory so much, except that inventory is, as I sort of noted earlier, sort of an ancillary feature of the revenue stream. And some companies do. I go to my dentist, and they're always trying to sell me like a water pick or whatever, right? So that didn't used to be a thing, but maybe that's beginning to be a thing. I have no idea how they account for inventory at my dentist's office. Maybe I should ask, and maybe they'll tell me to get lost. But you kind of get the idea that in the service context, one of the characteristics of services is that the product itself cannot be inventoried, and so as a result, there is no issue of creating an asset and selling it and cost of goods sold. You have cost of sales, which is related to the revenue to the extent you can apply that, but there is no inventory per se. Okay. All right. So quick little one of these mini quizzes, the concept check. The Golson company uses the periodic system, and information is as follows: you get sales, you get inventory, all that. And so, what is the cost of goods sold for 2021? Well, let's do the math here and go with it. Now, remember, this is a periodic system, and so as a result, we're going to start with beginning inventory plus purchases, which equals goods available for sale or cost of goods available for sale minus ending inventory equals cost of goods sold. That is the basic formula, and it's something that I would sort of get to know if you're not terribly familiar. It's just something that should be intuitive if you're going to study accounting and whatnot. We start at the beginning inventory, 340 plus purchases, 600, minus any returns. Remember, this is a net purchases example. We probably did not focus on the net angle so much in principles 1, but it's an easy adjustment. And then minus ending inventory gives us 564 as cost of goods sold. And so the answer to this one is letter D. Okay. And we have all the information we need here in order to do that particular calculation. Okay. Pretty simple, and gets us to the place where we need to be. And assuming that the ending inventory is correct, and we should be good. All right. Following up on this, the Golson company uses the periodic system. Information is that's the same question, isn't it? Oh no, no. Here they want ending inventory. Sorry about that. They wanted cost of goods sold here. Now they want ending inventory. All right. Well, that's all right. Well, we just kind of did that, didn't we? And we already really calculated ending inventory, and we ended up with 370,000. So we kind of did the same equation. It's kind of threw me there a second because I thought it was asking the same thing, but it's all we already sort of calculated it, and the numbers are the same, so the math is going to still work out. So ending inventory, which is clearly a different figure than cost of goods sold, is calculated using the same methodology. But again, remember, this is a simple algebraic equation, and we can either solve for ending inventory, or we can solve for cost of goods sold, or we can solve for any of these. It really depends upon what variable you're trying to calculate. And so, in that regard, the math should not be terribly difficult, and it looks, I think, mostly straightforward in this case. All right. Okay, let's move on here and talk about physical goods that are included in inventory. This is where, and some of this may have already been covered, and some of you who may already work in the business world or even in accounting may be well familiar with these ideas, but these concepts. But what is included in inventory? So we're talking, and one of the things about inventory that we should note is that they typically have a physical nature. You can put them on a truck. They can burn up in fire. They can be stolen. They can they can be damaged and whatnot, but you can move them around. And that differs from a service, in which case that really can't happen. I can't ship my haircut to you in Kansas City, right? It doesn't really work. And so as a result, there's a physical element to inventory in almost all cases. And so what are we really talking about here? We're talking about the idea, how do we define inventory itself? Well, obviously, the most obvious is if it's in physical possession of the company. But even that is maybe a bit misleading, as we'll get to in a second. But if it's in physical possession and the company has legal title to those assets, then clearly they are in. They would be booked in the inventory. Goods are in transit. Now we'll talk a bit about this. This is something that we covered a bit in Principles 1. This idea of who owns the goods when they're on a truck or a boat or a train, and what are the ramifications of that ownership reality. It's a legal distinction that does really make a difference. Also, goods on consignment, which is why the first item here may not quite always hold. That is, we can have physical possession of goods, but they don't belong to us. And so as a result, they're not in our inventory. I say our, like we're the company here. So as a result, we'll talk about consignment goods. And also anticipated sales returns, which is an estimate made in order to sort of satisfy the matching principle. That is, we're going to do some sales, but some of the sales are going to come back for whatever reason. The goods are damaged, or we have a very liberal return policy. And some companies have had over time extremely liberal return policies. And so as a result, they would have to factor in returns as really a contra revenue to sort of reverse the original sales in the first place. So, and it does happen. And I think Nordstrom is one example where, and I don't know if they still do this now. I don't believe we have a Nordstrom in Albuquerque, but they would almost take any kind of good back, even if you didn't buy it there. I don't know if they still have that policy, but my point is that they would have to anticipate that particular figure as something that would be booked back in inventory if the goods come back, assuming that people return those goods in more or less the same condition in which they were sold. So, all right, so let's kind of talk more about inventory and these different elements here that refer to it. And the first issue is goods in transit. This is really not all that complicated. It really refers to what the agreement is between buyer and seller. And we're almost always talking here about business to business transactions. In a lot of intermediate accounting, that's the way it is. If it's business to consumer, well, it's not all that different actually. But in this case, we're going to assume here that it will be determined ahead of time who pays the freight, and who pays the freight that determines what the ownership of goods are, right? So when the goods are on the way to the destination, somebody owns the goods, right? Until either the goods are dropped off at the loading dock of the destination, or when they leave the shipping dock of the originating point. So the question is, who owns those goods? And that's really what we need to determine, is who owns those goods. And that's a big issue. And it's got more implication than simply, I own the good now because it's on the truck between Chicago and Houston or whatever. But it could be the fact that maybe that shipment is damaged, or it's destroyed in a crash. And whose insurance pays for it? That's kind of an issue there. So we get to this idea of what we call FOB, which stands for free on board, which is a very old school term, going all the way back to when goods were shipped by boat, and as they passed over onto the boat itself, it would be on board. And so as a result, if title transfers at the shipping point, it means that the buyer has title of those goods, right? So that's what's called FOB shipping point. Now, in invoices themselves, you'll see, and it usually won't be the terminology FOB shipping point, or conversely, FOB destination will be, let's go to Chicago to Houston. If their FOB shipping point is going to be FOB Chicago, right? So meaning the buyer in Houston takes title once those goods hit the truck or the train or whatever the carrier is to transfer those goods. Okay, and And as a result, they book that inventory at that point in time, right then and there. And typically, it's also a legal issue because they have responsibility for those goods, and if anything goes wrong, whether it's the goods are stolen, destroyed, destroyed in a crash, well, their insurance, the buyer's insurance, is what's affected. It's probably the most common form, I think. It's usually the case where buyers pay the freight, and the freight, it becomes an inventory cost, and we'll get to that in a second. This may be review from where we talked about this in Principles 1. And so we'll get to the idea of freight here in a second. But if it's FOB destination, it means the seller owns the goods until those goods get there. So as a result, these goods are crossing the accounting period, right? In this case, the goods leave the shipping point on December 29th, don't get till January 30th or January 3rd. So again, we're assuming the year end, fiscal year end, is December 31st. And so somebody's got to own those goods. We have to make sure that we know what the terms of the transaction are. And if it's FOB shipping point, the buyer owns them as of the date that they hit the shipping dock and they're gone. If it's the other way around, the seller owns them until they get to our receiving dock, and then only then do they become ours. And so that becomes an important issue there. And then we get into all kinds of documentation like bills of lading, which spell out the terms, and sometimes receiving managers will make sure that everything is on that invoice list is there and physically there and whatnot. So these are the ways that we sort of account for goods that are moving around, and a lot of goods move around. This is not a newsflash to anybody. We've all seen lots and lots of trucks on the interstate, trains hauling freight, and part of the country where I'm from, we had a lot of freight traffic, a lot of ocean or boat traffic on the Great Lakes. A lot of these very heavy goods that moved like steel and what you just can't ship them over land. They'll break the infrastructure. So the question is, who owns that? Who owns those assets and when? And that's how we do the accounting for it. So those are goods in transit. So quick question here. Barrington Corporation uses the periodic inventory system at year end 2021, which is the fiscal year. The physical count inventory revealed an inventory balance of 80,000. The following items were not included in the physical count. Those were merchandise shipped to a customer FOB destination, okay, for $3,000. Okay, so that was not included in the physical count. FOB destination, remember that. Merchandise shipped to a customer on 12/20 FOB shipping point, okay? And then merchandise purchased from a supplier shipped FOB destination. So what should ending inventory be? Well, this is not terribly complicated. The only thing that's different here is the idea that we've got, and it's actually highlighted for us. So it's not, the answer is sort of suggested here. It's the goods that are shipped FOB destination because they still belong to the seller until they get to where they're going to get, which is going to be on the 5th of January. And so we're going to put those back in inventory here. It wasn't included, but that's something that is an error, and we should include that, right? Now you may think, okay, $3,000, no big deal. Well, what if it's a bigger sum? And what if it's not just this particular shipment, but it's a lot of shipments where we're making mistakes? These really can create distortions in all kinds of elements of the financial reporting. So we want to make sure that this reporting is in fact mostly accurate. Okay. All right. So let's talk a bit more about goods in transit. So, I guess that was all for the goods in transit. Let's talk about consignment, because I sort of mentioned this at the beginning of this particular piece, in the sense that yes, you get a physical title of the goods, but they really don't belong to you, and so physically possessing them does not imply that it should be booked in an inventory. And we're talking about consignment here as being a fairly common business arrangement. And we'll talk about some examples of when consignment happens. A lot of you may be familiar with consignment goods. All it really is the idea of some seller taking goods from some buyer, from some other seller that for whatever reason maybe can't access the demand side of the market. Maybe it's a smaller producer somewhere, and they say, look, I will give you these goods, or well, not give you, but I'll let you try to do what you want with them. If you sell it, you get a commission. They stay in my inventory until you sell them. If you want me to take it back anytime, just call me and we'll come and take them back. We'll get them out of there. And that's really what's happening here. It's usually the case where you've got really some smaller seller that does not have access to the broader market. And there are certain areas where this really is fairly common. As an example, I don't know if I told this class, but my first wife worked for Home Depot. She was in management, and they would have lots of flowers outside the store at night. They would just kind of leave them there. And they said, well, if they get stolen, they get stolen. They're on consignment. We don't own them. We made clear to the seller that they're not our problem if somebody steals them. So they just weren't worried about anybody coming and stealing flowers at 3 in the morning or whatever. But you're going to get the idea. And I don't mean to suggest this cavalier attitude toward inventory in general, because sometimes these goods are quite valuable. I'm thinking about artwork, particularly auction houses that deal with very expensive artworks or unique items and whatnot. And those goods are not owned by the auction house. The auction house will collect a commission. Those goods are still in the legal ownership of whoever owns them, but can't sell them because they don't have access to that particular demand side of the market. So that's essentially what's going on. The consignee is the party that is being tasked with the sale. If the buyer is not found, the goods are returned, and it's usually a phone call: "Come get your stuff." That sort of maybe not quite that blunt of terms. If a buyer is found, then there's a selling price, and part of the sales price will be carved out as an expense to the seller or the consignor, and then as a revenue to the consignee. And so they collect a commission. There are all kinds of instances in which consignment happens. Also, I think sometimes things like magazines and newspapers are often consignment goods because retailers don't want to have newspapers that are on their shelves for. Who wants to buy a 2-day-old newspaper? So if the newspapers don't sell, they come and get them, and they just simply collect a commission for anything that they sell. And that's kind of the way that whole thing works. Newspapers, magazines. Also, I think I recall from back in the day that some health and beauty aids type vendors would come in and call them the jobbers, and those goods would be on consignment. And if they sold, they sold. If they didn't sell, they didn't sell. But that's essentially what a consignment good is. And so if you're the consignee, you don't book it in inventory at all. All you're doing is collecting a commission, and that's really all. And that's essentially what's happening. So the terms that we want to know are consignor and consignee. Goods are held on consignment are in the inventory of the consignor. That is the original owner of the good, and the remaining owner of the goods. And it's only recorded when those goods were sold. Title passes on to somebody else. So in this example, let's do a quick one here. Pratt Clothing is the consignor. They ship merchandise to Regal Outlets, which is a consignee. The arrangement specifies that Regal, which is the retailer in this case, will attempt to sell the merchandise, and in return, Pratt will pay a 10% sales commission on any merchandise sold, and any inventory not sold within 6 months will be returned to Pratt. And it's usually the case where the original consignor has got to come pick them up. It's usually the case. We're also always talking about physical goods in this case. And so Regal retains physical possession, and they have a responsibility to try to sell it to customers. But very often it's like, if we sell it, we sell it. If we can't, we don't. Now, it's good business for them to sell it. They want to sell it. Otherwise, why waste effort on something and if you can't sell it? But it's usually a less stress environment because it's really not your inventory that you're trying to sell, but you do want to sell it. It's good business to do that. So Pratt, though, the consignor, has legal title to it, and it puts it on their books until the goods are sold, and then they get the remainder of the revenue after the commission is taken away by the consignee. Okay, and all this is a deduction. So if it sells for $100, $10 goes to the Regal, the consignee. $90 goes back to the other party, the Pratt in this case, and the transaction is done. Okay, not too difficult in terms of how this whole transaction works. Okay, and ask some questions, but I don't think anyone's on the call here. So let's talk about sales returns and what they are. And I think we've talked a bit about these. Hopefully, these are mostly review items from previous experience as to what you've studied in the past. But let's talk about what's happening here with sales returns. So it's the case that customers typically do return some quantity of goods for whatever reason, and this amount should be estimated, and it should be sort of tied and matched to the period in which the sales were reported in the first place. But what happens is essentially the sales transaction is reversed. That is, it goes back in inventory. So we debit inventory, we credit cost of goods sold. Cost of goods sold is a debit balance account. It's an expense, but we're reversing that and we're crediting that and we're debiting inventory so the goods go back in. We're assuming the goods are returned in saleable condition. If people try to bring back something that's in bad shape, well, that's a different story. And sometimes they do, and they say that's the purpose of the return is it's defective, and that's a different element here. But we're talking about somebody returning it for whatever reason. Maybe it was late in getting wherever it needed to get. Seller is or the buyer is dissatisfied, and so as a result, hey, I'm sending this back. Please credit me the amount of my purchase price, et cetera, et cetera. And so all we're doing is simply reversing part of the transaction. What does it look like from an accounting standpoint? And we'll sort of talk about that here. So let's talk about and we'll talk about the idea of how we adjust those. But so what kind of transactions are we dealing with here? Well, when we talk about purchases, we're acquiring inventory, and we'll also bring it to its desired condition location, and we're also adding things like freight charges. Now, remember, one of the things that actually I thought there was more on sales returns there, but I guess not. So anyway, sorry about that. I thought we had a slide here. Maybe I don't know if I deleted it or not, but anyway, but sales returns are going to happen, and I think maybe it comes up a bit later, even in this chapter segment, where we make an estimate of what those returns ought to be, based on past experience and future expectation and whatnot. But anyway, let's move on to the next topic here, which is transactions that affect net purchases. Now, one of the things, and again, a lot of this, at least this early part of chapter 8, is sort of review, I think, from some of the material that you may have seen before. So what are the events that go on to affect what goes into purchases? And so remember, one of the things that we say about inventory is that inventory is the cost to acquire, or the value of the inventory is the cost to acquire the inventory and to get it ready for sale, whatever that means. Maybe there's some light assembly we need to put together. Maybe there's a display case. Maybe we've got to do some things to it, but it's all those costs become part of it. And one of the big ones, of course, is freight. Particularly if we're the buyer, we're buying goods, they're being shipped to us by, say, semi-truck, that those charges are going to, and we're paying that, then it's going to go in the cost of inventory itself. And we're going to sort of create a separate debit, and it's an inventory account just for freight. We typically call it freight in, and we're going to get to that here in a second. So these are some of the costs that go on here. And again, any kind of returns and discounts. This is the other side of the transaction where a second ago we talked about sales returns, where we're the seller and goods are coming back to us. Here, we're the buyer, and we're saying, we're sending some of those goods back for whatever reason. The same kinds of reasons that our customer would return them. Quality issues, maybe they're defective, not exactly what was ordered. Sometimes there are errors and whatnot. And then also discounts also reduce the cost of purchases. And if we're doing a purchases account, like in a periodic system, those discounts become a reduction in the price of the good itself, and it's adjusted as we get going. So let's talk about freight here a bit, and talk about what's happening with freight. So we're talking about the shipping costs to get some good from point A to point B, and we're going to take the point of view of the buyer here. Excuse me, which is why we're going to call this freight in on purchases. And the term freight in is an account. It's a temporary account. It's an inventory account, basically. And so again, all these costs that are getting the good available for sale, everything that we need to do in order to get those goods available for sale. So freight costs are a part of it, and they're an inventory account. In a periodic system, which we've talked a bit about before, we have this temporary account called freight in, sometimes called transportation in. That's kind of been a term in vogue for some time. But freight in is often what we are referring to it as. Not freight out. It's a different story. Let's not confuse ourselves. Freight in is part of the inventory cost itself. And so on outgoing goods, these costs are not included in the cost of inventory. Those are treated as a period cost, and they're simply treated as an operating expense usually. Yes, they can be treated as part of the cost of goods sold, but typically they might be an operating expense. I mean, I think often, and I think it varies across industries, and it'd be interesting to sort of know what the terms of freight accounting is across industries, but it's oftentimes the buyer that will pay the freight. As a result, the freight cost will go in the cost of inventory itself as a separate category on its own right. But goods being shipped out are oftentimes a different matter. Yes, it could be part of cost of goods sold if you really wanted to do that. And that's, within your discretion to do. By the way, these costs, at the end of the day, are going to end up, a cost is a cost. You're going to incur it at some point. The issue is one of timing, and it's one of attachment to product cost. It affects gross profit and gross margin. It's not insignificant, but at the end of the day, it's going to be the same case, because a cost is a cost, represents the outflow of equity from the firm. Okay, so purchase returns, in this case, we're the buyer. In a perpetual system, what do we do? Well, it's a little bit more straightforward here. So remember, the good came into inventory right away, and so in this case, if we're in a perpetual system, if we're reversing it, or we're sending the goods back, and we'll talk about, I guess it depends on who pays the freight. Oftentimes, if you're the guilty party, if you like, they'll pay the freight for goods to come back. But simply all you're doing is simply crediting the inventory and debiting cash. If it was for cash, and if it's for a receivable, for a payable has a credit balance, you reverse that and make it a debit. So you have debit payables, credit inventory, or debit cash, credit inventory, whatever the arrangement was in the first place. But that's how we would handle it in a perpetual system. It's actually a little bit easier, frankly, to do. Okay. In a periodic system, you get this returns account, which again, in a periodic system, we're not really on a real-time basis accumulating this information. We're just simply making postings, debit and credit postings to things like purchase returns and whatnot. So, and at the end of the day, or at the end of the accounting period, we're going to compute total purchases. And one of those deductions from purchases is going to be returns. And so, and that's just simply the way that is going to work in this case. So, but it's obviously a slower method, but again, it may not be that difficult, particularly if again, the revenue that's accounted for in the periodic system is not that significant, or if the company simply is unable to deal with it. And again, I also mentioned the case in which companies are really very, very sure of their margins and have a pretty good eye for pricing. There are a lot of business companies, particularly even a lot of small businesses, that are really pretty sharp recognition of what their costs are. They kind of know what it costs to do something, what price they have to charge, and accounting is maybe not the foremost topic on their minds. And obviously, to accountants' minds, that sounds like something that's not particularly wise, but whatever works. I know that we tend to view accounting as being a critical function, and we think it is, but there are a lot of companies that have more of a marketing function or an operations function, so or a focus, I should say. So, all right. So, real quickly, let's talk about discounts. So, obviously, any kind of discount is simply a reduction of the price paid. We talked a bit about this idea of discounts before, and we would call these cash discounts, meaning that it's you get a discount for paying cash early. 210.30 is a very common scheme, where a seller will offer 2% discount if the invoice is paid within 10 days. Usually it's the invoice date. Usually it's not always the date that goods get there, but it's the date that the invoice is created, and the buyer is aware of that invoice date. If instead the buyer doesn't pay in that period of time, the net amount is paid in 30 days. Now, what does net mean? Net means net of any other discounts that do not involve early payment, and such as any kind of trade discounts, like you're a good customer, we're going to offer you this discount, and also we're going to offer you another discount because it's a seasonal item that's what we want to get rid of, and so if you can sell it, we're going to offer you 4% off, or whatever the case may be. So when we say net, we're talking, it sounds like we should be saying gross, but it's net of any other discounts that are taken. Cash discounts, which are discounts offered from seller to buyer for early payment, are not always offered, and you can't always expect to get them. Clearly, we talked a bit before in the last couple go-arounds about why a company would prefer to take a discount, and that's usually because even if you have to borrow money, the cost of financing is going to be much less than the value of the discount itself from a lower cost of inventory. But you get the idea. So, and there are two ways of doing it, either the gross method or the net method. Both are going to get to the same area. I think GAAP accountants or GAAP accounting principles sort of favor the net method. The gross method, I kind of like it personally, but that's my own personal preference here, only because it sort of reflects the original reality. So in this case, if we're talking about the gross method, we're talking about buying 20,000 of inventory and 20,000 of accounts payable. Debit inventory, credit accounts payable. Easy peasy. In the net method, we're already taking the discount even before we take the discount. And if we don't take the discount, then we have a way to account for that discount that's forfeited. Okay. And I know that that's an information item to users about, hey, management was not effective at taking discounts. And so as a result, that becomes an issue. So when the invoice is paid, if in the gross method, let's say we do take the discount. So as a result, simply the reduction of cost of inventory. Remember, assets are booked on the balance sheet at the cost of acquisition. So we're reducing the cost of that by $280. Okay. And so as a result, accounts payable, which we're going to debit because we're going to pay it, that goes away, but we're only going to pay $13,720. So that $14,000 invoice is now only is paid at $13,720 because we recognize inventory as a reduction in cost of inventory, credit balance to offset that, to make that balance. In the net method, we've already assumed we're going to take the discount. So as a result, cash and accounts payable, pretty simple deal. It's the same discount amount, 14,000 times 2% is 280. But we've already recorded this at the net figure, assuming we're going to take the discount, right? Assuming we're going to take the discount. If we take the discount, then that's the way it is. Now, if we don't take the discount, under the net method, you're going to have an account called purchase discounts lost, purchase discounts forfeited, whatever the case might be. It's not that big of an issue. By the way, it's a $20,000 invoice, and there was a partial payment of $14,000. So we only get a discount on the amount we prepaid in the 10-day, what is it, 10-day period. And so as a result, in the gross method, we're simply going to zero out the rest of the amount payable, which is $6,000. Here, if we don't, we only took a discount on the first $14,000. So we've given up the 2% discount on the $6,000 we did not pay. So we're going to have a debit here that's going to balance out the rest of the cash. In either case, whatever method we use, it's still going to be, we owe $6,000 on November 4th. And if we took the discount under whatever method we use, if we took the discount, right, go back 1 year, we're still going to pay the same amount, $13,720, right? That's assuming we took the discount, all right? And if we didn't, the portion that we did not take, it's not subject to the discount, but the seller could care less what method the buyer is using. We're talking about the buyer's point of view here. This is how we're treating it. And the net method, we have a forfeited amount, and it's one of those reporting line items that sort of gives information to management and I guess potentially to users about the efficiency by which we manage our assets, our resources, and whatnot. So rule of thumb, most companies will want to take advantage of a discount that is a cash discount. These numbers aren't particularly large, but what if they are large, and these 2% discount may be very significant in terms of helping to aid gross profit that may fall all the way to the bottom line. So where possible, companies ought to probably take advantage of those. Okay. All right. So we're out of time today. It's 11:45 here on Thursday. So I will pick this up on Tuesday. Look for supplementary videos in Chapter 7 dealing with cash and receivables. I want to make sure I get to more of that. It'll probably be tomorrow sometime, just given the realities of what availability. A lot of us aren't here on Friday, so I've got time to do that. But if you have questions about anything, feel free to get with me. I'm here pretty much every day. I'm also here on Saturdays as well. I'm free to meet with somebody over Zoom or here in the office, whatever the case might be. And I'm more than glad to go through problems with you and to answer questions and help out any way I can. All right. Well, if I don't talk to you individually, which is possible, have a good weekend. I will talk to you next week.